Welcome to the inaugural series of The Impact Bite, the podcast which showcases the various perspectives of different investor categories in relation to the current investment landscape. My name is Will Lowry, and I co-lead the Institutional Investor Network at ClearlySo, Europe's leading impact investment bank. I will be your host for this week's daily series, in which I look to test investors' genuine appetite for impact investments, as well as challenging 5 highly relevant yet different investor profiles in order to gauge whether the investor lens really does vary across family office, impact funds, private equity, venture capital trusts, and corporate venture capital amidst a post-COVID-19 investment environment. I am quite literally spoiled for choice in today's VCT-focused episode of the Impact Bite Investor Insight series, being joined by 2 of the market's most highly regarded early-stage investors. In no particular order, I promise, it is a pleasure to introduce you to investment manager Helen Villiers, who joined the team in 2019, joining from Grant Thornton to assist across the origination, evaluation, and execution of new investment opportunities, and founding partner Paul Cannings, who was directly involved in YFM's management buyout over 10 years ago, and now leads the firm's impact agenda, as well as sitting on the board of Social and Sustainable Capital. Welcome, Helen. Welcome, Paul. And dare I say it, may this be the start of a famous double act routine across YFM's wider marketing efforts going forward.
Let's hope so.
Good stuff. Well, look, Paul and Helen, the whole purpose of the Impact Bite series is to try and compare and contrast the views of a wide range of different investors during these trickier times. This episode will focus specifically on your VCT lens. And maybe you could kick off by sharing your key takeaway about the VC market during this period of lockdown.
Yeah, so I'll start on that, shall I, Will? I've been investing in small growing businesses since 1990. And 1990, of course, was the start of that particular recession. We've then been through booms, we've been through busts, and all the way through those, I think the same mantra applies, which is that if you can find a good business which is led by a good management team, then they will find a way to adapt and survive and prosper in good times and bad. And I think if we look back across those economic cycles, the key for us is to stay as a supportive partner for those businesses as they go through those periods of transition, and support the management teams so that they can find a way through and continue to grow their businesses.
Yeah, and I think I would add to that, from the other side of the double act, this is my kind of first recession or downturn to have worked in the kind of investment world. And I think I've been really surprised at how much the founders and kind of businesses we're working with have been able to adapt. I work across both our private equity and VCT sides of the business. And I think my assumption had been those smaller, earlier stage businesses might struggle, but actually the kind of good management teams have really found ways to pivot their businesses and continue through this.
Perfect. That's really interesting. And Paul, one area that you touched on, I guess, is the experience that you bring as an investor. I certainly see that as a huge value add when talking to our corporate clients, who often seek patient capital and often look for a particular type of investor when partnering going forward. But obviously the expertise that you have experienced is hugely valuable, and you can help management or guide management accordingly. Do you think, that there is the rhetoric at the moment that investors are open for business as usual? Do you think that as a VCT, or with your own experience, that you YFM, for example, are actually more open than other investors who might not be as knowledgeable in investing in these trickier times?
I think that's difficult to say because all investment funds take slightly different approaches. So we, with our VCT funds, are able to take quite a long-term approach because this is evergreen money, and therefore we can take a 5, 6, 7 year view of the growth prospects of a business. And so if 2020 turns out to be a tricky year, or indeed if 2021 turns out to be a tricky year as well, then we can just put that into the mix. And as long as still there is a good business there that can grow in value over the next 5, 6 years, then that's something that we'd still be keen to be involved with and to help. We generally have sort of not taken a sector specialisation view in our funds. So I'm sure that if we were a fund which was concentrating, for example, on the consumer or the hospitality sector, this would be quite a difficult time to say that you were still open for business. But we've always taken an approach of being sector agnostic about the investments that we make. But the thing that we do specialise in is helping businesses who are about to go through a fast stage of growth. And that's the bit that over the years we've got lots of experience of doing and know a lot of the issues that are going to be faced and the best way to support businesses through that.
Thank you, Paul. You mentioned the prospects of 2020 or 2021 potentially being slightly trickier years. Do you think that the investor founder dynamic has changed as a result of COVID-19? And critically, has this impacted your own investment process going forward?
So for us, we are quite often backing, with our VCT funds, we're quite often backing founders. But the stage that the business has typically got to is one where the business needs to sort of move on and develop beyond just the founder stage, and where they need to professionalize and improve their corporate governance, as well as continuing to grow their business in a sort of entrepreneurial way. So I don't think really that has particularly changed as a result of this sort of what hopefully will be a relatively short-term crisis. We have certainly had to, if we look at our portfolio of existing investments, we've certainly had to support some of them and look to put some more funding behind some of them. But if we've backed the right business and we've backed the right team, then, and as long as we've structured our investments so that our interests are aligned with the management team, then basically the relationship should work, and we should be able to get through good times and bad, with us and the management team and the founder all on the same page.
And in terms of incentives, and making sure that you're on the same page as you mentioned, do you think that deal types will change? Do you think that there will be structural enhancements to transactions? So will we see the likes of fully participating preference shares or even convertibles becoming a more common feature of deals going forward?
So we've always been quite keen on fully participating preference shares, actually. So we think it's actually quite a good way to align interests between the investor who wants some downside protection and the founders and management team who want to retain as much of the equity upside as they possibly can. And actually, fully participated liquidation preferences are actually quite a good way to line up those two things. I think if anything, in a time of downturn, perhaps there will be less demand and perhaps less enthusiasm from our side for cashing out the key members of the management team at the same time as we're putting money in. But what we have found is that quite often, as well as the business needing some money to help it to grow with our VCT funds, then actually there is a bit of sorting out of the shareholder base that's needed at the same time. So there might be a co-founder who's no longer involved in the business, or it might be that there's been a little bit of a falling out with one of the old members of the management team who's now left. And actually, we at YFM is actually in the fortunate position of having a sort of sidecar fund that we're able to use to sort out that sort of shareholder issue and buy out some of those shareholders at the same time as using our VCT funds for the growth capital part of the investment.
Helen, do you want to maybe add in anything there?
I think kind of the only thing to add, particularly going back in terms of the investor-founder relationship and our kind of process going forward with new founders, I think our process hasn't changed as much as it might have done. I guess sadly we're kind of doing all of our management meetings over video call now rather than meeting them in person. But kind of linking back to our earlier point, not to kind of hark on about it, but I think if you have a good business and a good management team, actually now is a really good opportunity to see how they react when things don't quite go to plan. And as an investor, kind of we recognise things don't always go to plan, and it's trying to make sure you're backing the right people who know how to adapt in those situations. So perhaps you could see this as a good opportunity. And I guess kind of processes probably are going to move a little slower. Trying to do diligence virtually, I suspect, might be more challenging over the next few months. But other than that, I don't see why there's any reason we shouldn't continue to back good people and good businesses.
Do you think that will be or may become a standard part of your investor DD? So when meeting with a company in that initial meeting, asking them how they handled the immediate aftermath of COVID on their own business?
Yes, I think it will be, certainly over the next year or two. But it's going to be something we have to take into account when assessing businesses, even kind of their financials anyway. We've had this year, maybe 2 years of kind of blip. For some businesses, that could be really positive, and actually they've won a load of business over this time, and for others perhaps not. So we're definitely going to have to take into account how the business has been impacted and how the management team have reacted to it, I think.
And Will, if I could just jump in there as well, I think it's really interesting that that we're sort of focusing on what we should be thinking about and how the management teams have been coping with this. But I'd also flip that the other way around and say that when a management team is thinking who they're going to choose as their investor, I've always say to management teams when I first meet them, you must take references from the investments that the private equity investor has already made, and find out how they behave when things go faster than plan, and find out how they behave when things go wrong. Because and it never ceases to amaze me actually how few people actually take me up on that and actually take those references up. But for me, that is the key to picking your investment partner. It's not whether they want 22 or 24% of the equity. It's, are they the right partner for your business over the next 5 years? And finding out how they behave when things get tough is pretty key.
Well, Paul, I think you've committed yourself there. I think you're going to have to dust off your referee list to make sure that they're all saying positive things, which I'm sure they will anyhow. But you've really committed yourself to that one. So I think the Christmas card list has been extended on your front. I guess I'd be interested to hear maybe if there have been any resources or tools that you would recommend to fellow investors as a result of your experience as a lockdown investor.
So I think I'll do a tip. I think the tip is to hold your nerve. As we said at the beginning here, we are looking for businesses which are going to significantly grow in value over the next 4, 5, 6 years. and you just need to put in context, whether the fact that they might have 6 months or 12 months of tricky trading to get through. And for me, it's about picking those businesses and management teams that are going to make the value growth journey over the next 5 or 6 years, which is much, much more important than any difficulties they might have short term.
And I guess I probably have a general kind of resource or something to keep doing, which is, however unnatural that may have seemed at the beginning of lockdown, I think continuing with kind of coffee mornings and webinars with your network as much as possible, I found really important. And I think as investors, we are sociable people, and that's why we enjoy our jobs so much, kind of meeting with founders of businesses, meeting with other investors, meeting with advisors. And yes, I kind of massively miss getting out and kind of seeing people face to face, but the value of still trying to keep those relationships up, and the kind of sociable aspect of the day-to-day job, I think is really important.
So the YFM double act has been very aligned so far in this interview series. I wonder whether the next question could lead to a bit of divergence. If you could both invest in any deal tomorrow, what would it be?
Okay, I'll have a go at that one first. So an ideal business. I don't really care what the sector is, actually. And that is a bit of a theme of how YFM does its business. But let's say if we're going to pick one ideal one, it would be great if it was a business which had some proprietary technology or know-how. That would be good. And it was an already successful business that was looking to take a big step forward, perhaps to launch into new international markets. That would be good. And it was raising, say, £4 or £5 million of capital to do that. And just going back to something we were discussing before, perhaps it needs £500,000 or £1 million to replace some of its existing shareholders. And then just needs to be led by a strong management team that's got a clear vision for building a valuable business. And then from my point of view and from impact point of view, one where the management team get it about building the fact that building a valuable business can also mean building a business which has a healthy impact on the environment and on society. So I think if we could have all those ingredients in one pot, that will be great.
Yeah, and I'm sorry to disappoint, Will, but I continue with the alignment point here, and I think Paul has kind of struck the nail on the head. Perhaps if you could throw in there a business that's got a massive garden that we can all meet at a socially distanced meeting at the moment, that would be wonderful. But I think Paul's ticked all the boxes.
Well, you're keeping me on my toes as the corporate advisor. I now know what to look out for. Paul's criteria followed by the garden as well, Helen. I'll see whether the team can do you a favour there. So the next question, which might finally help to crack this YFM double act, is one about ranking deal characteristics. So could you rank the following in terms of order of importance for you when you assess a deal? The first, management team, which I suspect might probably be at the top of the list for both of you. The second, target market size. The third, impact. The fourth, near-term profitability. And the last, high growth.
Okay, Helen, I'll let you go first on this one.
I was going to say, I can jump in and finally get to go first on one, so Paul can try and think of a way to differ in opinion. So yeah, you're right. Management team would always be number one. For me, I kind of think if you're backing good people who can adapt in this type of environment, to an extent, what the business does and what sector it's in shouldn't really matter. So management team would certainly be number one. Two, probably high growth. Or kind of the prospect of being high growth over the next kind of 5 years, obviously is important for us as investors. And third, kind of linked to that, is probably the target market size. that's a difficult one, because it depends kind of on the business and on the sector. And actually, do you want a tiny part of a massive market, or are you looking to kind of be market leader in a smaller market? I guess that's probably why that's number 3 for me. And then I'd say impact is kind of definitely the next on the list. As Paul touched on, I think we're really trying to push the kind of education of that across our portfolio and new investments, and making sure impact is a natural consideration during the investment process, and something that should naturally fit with the high growth, like growing the market, increasing the profitability of the business. And I think it's important to consider that early on. And then so last on the list for me would be near-term profitability. Obviously it would be excellent if we could invest in a business and they are making kind of masses of profits tomorrow, but we're kind of a patient, longer term investor if need be. So that's lower down the list for me.
And I'm not sure that mine are going to be all that different, I'm afraid, disappointingly. Will. Unlucky. Definitely management team is number 1, I think. I think number 2, I might actually put the market, actually, not just the market size, but the shape of the market, I think. So, are there some gorillas in the market? Are there, is it a market where actually it's very price sensitive, or is it one where actually if somebody's got a technological advantage, they can actually get a real advantage in the market? So I think market would be number 2 actually for me. And then number 3, can they grow fast within that market? So high growth and impact. Number 4, as I've already said, I think with the right management team, impact and financial success can go hand in hand. And then, as we've said all the way through this, I think short-term profitability is probably the least important for us in the VCT investing that we do. So nearly the same, but just a slight twist.
It's not. It hasn't caused the controversy that I hoped. This is really proving difficult to challenge the partnership here. YFM definitely are aligned, but I think that my next round should hopefully bring a bit of contrast to your answers. It's the quickfire round, where I will state 3 comments, and I'll ask you to provide relatively immediate and hopefully totally genuine responses to each of those statements. So maybe for the first one, I can start with you, Helen. And then for the second one, Paul, I can come to you. And then the last one, maybe I come back to you to lead on, Helen, just to make sure that we've got an agreed format, to make sure there is no collusion whatsoever on this quick fire round. So the first statement is private market prospects for the second half of 2020.
So my quick response would be, I think prospects are there for new and interesting ways of working, whether that be kind of holding all your meetings online, new sectors kind of taking off quicker than they might have done. I think there's a lot of opportunity for kind of a shake-up in the market.
And I would say that the second half of 2020 is still going to be a period of transition. Businesses generally thrive when there is a bit more certainty around than it looks like there's going to be on a macro level over the next 6 months. And so making brave investment decisions can be made more difficult when actually the economic backdrop and indeed all the COVID relaxing of the regulations are still very unclear as to how that is going to work. So I think it will be a harder time for businesses to raise money, but there should still be some good opportunities.
The second quickfire statement, and Paul, you'll be leading this one. Impact investing, a mainstream investment strategy or niche personal preference?
So for background, YFM is a financial return first investor. However, I am completely convinced that all businesses should have an eye on what their impact is on society and on the environment, and on the people that they work with. And a good business run by a good team can make excellent financial returns and treat its people well, treat its customers and suppliers fairly, and make sure that it is not having a negative impact on the environment or society. And so, and I think that it's really interesting, but when I meet and talk with the CEOs of businesses that are perhaps slightly younger businesses and slightly younger management teams, they absolutely get that. And they will find that their staff, that they're interviewing for new jobs, one of the questions they're asking in the first interviews is, can you tell me about your impact approach to the business? And certainly our investors as well have just started to sort of be asking those questions of us as well, and saying, we want to know what your approach is to quizzing your businesses that you're investing in about their impact, and how you're helping them to improve. And I'd say if you went back 10 years ago, that just didn't exist. But today, definitely some of our investors are asking us that question, and so it is becoming the mainstream, and rightly so.
I feel like this question is almost the title of an article I wrote about kind of impact investing with YFM last year, and echoes a lot of the same points Paul has made. I remember, I'll get the stats wrong off the top of my head, but one of the most powerful statistics I pulled out was the trillions of pounds of wealth that are going to transfer to the kind of millennial generation over the next 20, 30 years. And when you kind of talk about impact with younger generations and perhaps older generations, that the view and the kind of importance of that in an investor point of view was definitely more important to the younger generations. And so I think that transition from a niche personal preference to a mainstream requirement to consider impact is just going to happen over the next kind of few years, as the investors providing the funds to be invested into these businesses view impact as a really important element of the appraisal process. And therefore, the kind of investment managers such as YFM are going to have to show that they are taking that into account for their investors.
Final quickfire statement. Helen, I'll ask you to lead this one. Your most surprising lockdown hobby?
Okay, well mine, you both have heard a lot about before this call, but mine will definitely be all sorts of DIY, painting, decorating. I made the excellent decision to be halfway through a loft conversion with no roof and most of my walls knocked down just before lockdown. So that has been a fun transition to try and turn my house back into a home. My brother-in-law bought me a drill as my birthday present, which was laughed at the time, but I'm using it well. So my DIY skills have definitely been a surprise.
Yeah, so I'm not sure it's very surprising, but certainly my favourite hobby has been just getting out and about on my mountain bike. So I'm very fortunate to be able to do that directly from my front door. So was able to do that even when there was during the travel restrictions. And I have to say, just taking a break from the computer screen and getting out into the forests and the hills is a pretty great way to break up the day.
Fantastic. And having tried to get a bit of divergence in there, I think I finally managed to do so with the lockdown hobby round, although there is definitely a running theme there of being in the outdoors, whether it's Paul on his bike or Helen without a roof. But both of you, thank you so very much for your time today. I've no doubt that we will be seeing this YFM double act again, across far more influential channels in the near future. It's been really interesting, and I'm sure that our audience will have a lot to take away from the importance that you place on management teams, and specifically during what is a really challenging period for founders and entrepreneurs. But it might give them a bit of hope that should they be able to demonstrate their ability to manage through this situation, that will also sit down very well with investors going forward. And I should also add that if they've got a garden, that is clearly an added benefit for Helen's own investment criteria. But that's it from us today. And please do join me at the same time tomorrow. So 12:30 on Thursday, the 18th of June, for what promises to be a fascinating session full of coveted family office investor insights, as Eva Tarasova from Wharton Asset Management joins me in the Impact Bite Investor Hot Seat. You can register for tomorrow's interview via the ClearlySo website, www.clearlyso.com/insight, where you can also access the prior interviews from this week's series, including Panoramic and H&M collab, as well as today's session with YFM. Likewise, please do not hesitate to contact me directly on william.lowry@clearlyso.com. You've been listening to the Impact Bite Lunchtime Investor Series with ClearlySo. I hope you've enjoyed it, and I'll be back online with more of the same tomorrow.